afternoon, everybody, and welcome to this virtual roundtable on sustainable transitions, emerging markets, and beyond. My name is Aline Reichenberg-Gustafsson, and I'm the editor of NordSIP, the Nordic platform for sustainable investing. Our aim is to enhance the level of information about sustainable investing for professional investment, the professional investment community in the Nordics. And today, I have the honor of moderating this exciting panel on the topic of sustainable transitions. So let me introduce you to our panelists. First up, we have Marcus Ledberg from the Swedish State Buffer Pension Fund AP4, so the fourth buffer pension fund, Fjärde AP-fonden. And before joining AP4 in 2018, Marcus was an advisor on sustainable finance and the Swedish advisor for the World Bank Board in Washington, DC. And before that, he was a chief economist at East Capital for about a decade and worked also at a number of research institutes across Europe. Today, in his position as investment strategist at AP4, Marcus focuses on macro, emerging markets, and sustainable investments, among other things. Marcus, can you tell us a few words about what your role consists in and how far along AP4 is in its sustainable investment journey?
Yes. First, thanks for having me. I think this is a this webinar, the themes that we're going to talk about pretty much summarizes also my job description. I do macroeconomic forecasting for the fund, and also what we call thematic analysis, which to a large extent is connected to the climate transition. So I also write our climate scenario analysis, which is integrated into the overall macro scenario. And the point with both these, both the macro and climate transition, is to understand where the world is heading, and then to give input into our asset allocation. So what do we want to have more of? What do we want to have less of? And both the macroeconomic is a big part of that, and the climate transition is another important part of that. And then I work with the different teams, different asset classes, helping to implement that strategy.
Excellent. Thank you, Marcus. And next, we have Patricia Ribeiro, Senior Vice President and Senior Portfolio Manager at American Century Investments. So first, a couple of words of introduction to American Century Investments. And the firm was founded by Jim Stowers Jr. in the middle of the 20th century. And the idea behind the firm that Jim Stowers created was born from a passion for helping people to become more financially independent and to give back something that's more valuable than money. Today, the firm's primary owner is the Stowers Institute for Medical Research, and American Century dividends payments support the Institute's work of uncovering the causes, treatments, and prevention of life-threatening diseases like cancer. And the firm is built on the idea of doing more than just obtaining a financial return. And Patricia joined American Century Investments in 2006, and since 2009, she's responsible for the Emerging Markets Equities team, who currently manages a portfolio of $5 billion. She has more than 30 years of experience in the financial industry, mostly in emerging markets, and she's originally from Brazil. Welcome, Patricia. Can you tell us a couple of words about your role and help us understand what sustainable investment means to you and to your team?
Yes, good morning or good afternoon, most of you. Again, thank you for having me. It's great to be here and talking to all of you about obviously a very important topic that has become even more and more relevant these days. So thank you for having me. So yes, with American Century, managing money in emerging markets and equities in emerging markets. Specifically, we have a portfolio investing in impact which is great. So for us, impact, there's really three criteria we look for when thinking about this portfolio. One is intentionality, right? What is it that, and we'll talk more about that, I'm sure, today. So intentionality is really important when we look for names to own in this portfolio. The second one is obviously return on our investment. We need to also give that return to clients, very important. And then the third one is measurability. We need to be able to figure out and create a report, obviously, with measuring it, the impact that the portfolio has across, obviously, the different sectors and the different countries within emerging markets. So that's how we approach impact investing, or impact in emerging markets.
Excellent. Thank you, Patricia. And last but not least, we have William De Vries. I hope I pronounced that correctly.
De Vries, yes.
Director, Impact Equities and Bonds at Triodos Investment Management. So I should also summarize the unique background of Triodos Investment Management is the firm is based and founded on the idea of generating positive change through managing money. It's linked to Triodos Bank also. It's a bank founded in 1980 with a mission to help create a society that protects and promotes quality of life and human dignity for all by means of ethical banking. So another unique culture.
Yeah.
And William joined Triodos Investment Management in 2017 as fund manager of the Triodos Eurobond Impact Fund. Now he's responsible for a wider team, also for impact equities. And he's got a strong background also from several firms in fixed income management and the portfolio manager positions. William, can you give us a quick overview of how you work in your team and how you work around the sustainable investment practices?
Yes, Aline, I can. Thank you for having the opportunity to be here. We at Triodos Investment Management have, let's say, basically one approach, and we try to invest the money of our clients in such a way that we have a positive impact. And I know the word is a bit discussable, but we have this impact. We want to have a maximum effect on people, planet, and prosperity. That's our mission. We want to improve, let's say, the world and where we are living in, and the way we live with each other. Having that, being such an organization and working for such an organization, that means that we have several strategies, and I'm responsible for, let's say, the strategies that we use while we invest in what we call the liquid investments, so listed securities and bonds. And that's the only thing we do, only listed equities, listed bonds. In Europe and in the equity side, we do it on a global scale. My colleagues of the private equity and private debt department are more investing in a more team approach, but we on the listed side, we use 7 transition teams that we try to invest in, and by doing this, we try to get, let's say, a positive effect on the transition teams that as we see them. And at the same time, you might imagine that we are, let's say, very strict on what we don't want to invest in. And we have a long list of what we call the minimum standards that we use to also exclude any kind of company or any kind of investment. And that means that we have a real bottom-up approach. And as such, if we think that an investment is a good investment and has the quality that we want to have it, then we invested it, and we invested for the long term. That's how we do it. We are not an NGO. I want to be perfectly clear on this. We also want to have at least the same kind of return that a normal, let's say, investment portfolio would have. But this is how we do it.
Excellent. Well, thank you for planting the scene here.
Yeah.
We're going to dive into our theme now straight away. But I just wanted to remind the attendees, you can't speak, unfortunately, in this setup, but you can ask questions, and we have a Q&A function that's open for you. So please don't hesitate to ask questions, and make sure to integrate your questions at the right time and interrupt the panelists at the time when it makes sense. So please go ahead. Meanwhile, let's dive in. So William, you said that you're working around the transition themes. Can you already illustrate, perhaps just name some of these themes and get us started? How do you play this concretely in your strategy?
Well, what we do is we have the 7 transition teams, and to mention them, we think that there are some challenges that we see that we have to meet to have a, let's say, a more sustainable economy, a more sustainable future in this world. And from there, we found that we have the 7 transition teams, as we call them, which is sustainable food and agriculture, renewable resources, circular economy, sustainable mobility and infrastructure, innovation for sustainability, prosperous and healthy people, and social inclusion and empowerment. And for every company, every bond issue that we see, we look at it and we say, okay, is there a clear connection of this company or the product that this company makes or the services that this company offer or the way this company works with one of the transition teams? And if it is, then we are going to look into that, and we say, okay, what does this company further do? How is the profitability? But also, does this company do things that we don't like? Does this company really have, let's say, only positive aspects, and does it not do engaging, or is it involved in activities which we think are incompatible with our vision? If we find that, then we look at, let's say, the economics of the company as well. And if we think that it is a feasible investment, then our research department gives this name free to our fund managers, and the fund managers then start to invest in it. And this is a continuous process. So every year, every 3 years, we look at all these all our assessments. Like we once a year we have to look at the investment, whether it's still as feasible as we thought it from the beginning, and every 3 years we have to do an assessment on whether we think that it still fulfills, let's say, all our requirements with regard to the minimum standards. And this is an ongoing thing, and as such we have let's say a very concentrated global equity portfolio. And from there we can let's say we connect also with these companies. We have a continuous engagement process with these companies in order to ensure that they are still doing things that we like, and don't engage in activities which we don't like. So that's in short what we are doing.
Mm-hmm. Excellent. Patricia, in your team, which are the transitions that you have identified, and how do you make sure that you jump in at the right point along the transition?
Yeah, of course. So for us, the transitions happen very naturally. We don't force them in any way. But you know, there are always sort of strong or good exposure to areas like, for example, education, which is obviously something important in emerging markets, something that that if we think about it, it will be what is really going to help these countries to all evolve and obviously get better in terms of growth and everything else. So education is one that's a strong exposure in the portfolio. Healthcare is another one that's important. And it's also there for the obvious reasons. All these governments in emerging markets, or most of them, if not all, have really underspent in terms of healthcare. So it's an area that we can obviously have an influence in terms of, you know, looking at that transition and improvement there. Some areas of infrastructure as well is very important. For example, like water treatment and sewage. Very important in emerging markets. Again, areas where the governments have not really spent enough. So companies regulated by the governments, but they actually do invest in those areas. So there are always areas that are important, but one thing to highlight is when I mentioned initially that that's natural, wasn't forced, is really areas where you still see tremendous amount of opportunities to actually be involved and influence, right? And be part of that strong transition that we look for. So that is obviously very important to us. And then we also look, obviously, the financials. We need to do the financial analysis on all these companies to have the matching between sort of that transition part, but also the financial, right? Making sure that the process that we have in place in looking for companies that will give us that return or that excess, right, return that we look for is there as well. So we need to get the two. And then the third one is measurability. We also need to do our best in terms of being able to measure, right, that transition, what is happening there, not only this year when we're investing in it, but also the next several years coming on. As long as it's in the portfolio, we need to be able to measure as much as we can.
Excellent. And Marcus, so how does that fit into the themes that you have identified? I mean, we have talked about quite a few different industries, and it looks like a lot of the sustainable development goals also could be matched with those themes. Is that something you look at AP4, and how do you approach these transitions thematically?
Yeah, thanks. Let me get to the SDGs in a second. We are primarily working with themes that are related to the climate transition. That doesn't mean that we're not interested in other themes, but we think this is a major exercise. We're spending a lot of time on climate related themes or climate transition related themes, and you know, it's not you know, very different from what William described or what others. I think just mapping these big themes: electrification, resource efficiency, renewables, and then you can make, you know, a whole range of subcategories under those. Those are. I don't think the difficulty is to identify you know, major themes, and we may have 8 or 6, but I think that is not the difficulty. The difficulty is when you start to break it down into what does that value chain, the electrification value chain, look like? What does the EV value chain look like, right? And then we really try to understand that value chain, and then we look at it from you know, how mature is it? You know, where on the S curve is this development? Is it at the beginning, or is it, you know, is it late? Because that may determine if we're confident in going into that value chain. How scalable is this? Can we put, you know, a fair amount of money into this? So, or is it small? If it's small, does it have the potential to become large, or is it going to be a niche investment? And then at the end of the day, it's also about investability. Are there instruments available that we can invest into, or do we have to create instruments? So there's a whole range of these questions that we need to ask, but we do it through this thematic lens. And then when it's about to make the investment, we also have to, you know, look at whatever the universe is left when we've done this exercise. What are the winners? What are the losers? Is this clear? Or are there some of the incumbents that look like losers that may become winners if they do X, Y, and Z? Are there pure plays? Do we want to invest in the first movers, or do we want to invest in the ones you know, that are potential for big changes? You know, when they do things, maybe. So, and it's not one size fits all. So we have to go through theme by theme, value chain by value chain, investment by investment. And then when we think this, you know, we're confident in this theme, let's find an exposure. And then we can do that in any asset class, in any portfolio. It doesn't have to be fixed income. It doesn't have to be private equity. It can be both. It can be neither. And so that is the iterative process that we're going through theme by theme.
Great, and that really points to this to our next question, which is really about the mapping and the measurability of the investments. Patricia, you said measurability is something that is very important in your investment thesis. Can you just develop a little bit more and explain to us, like, give us perhaps a couple of examples of how this has evolved also in the past few years in terms of your investment process, how you measure, and how does the iterative process work?
Sure. So as you can imagine, emerging markets is sort of your way behind, I would say, in terms of really thinking about ESG and then measurability in terms of impact. So for us, you need to really, as part of, we've always engaged with corporates anyway. So this is also one other way of doing it. So if we cannot find, the company is not out really sort of being proactive in terms of giving us enough information to measure sort of that transition, then we need to obviously engage with the corporates and do it the same way we do on the financial side. Is it doing it specifically, trying to really capture, get as much information as we can in terms of, excuse me, in terms of that measurability. So it's very important because for us also in emerging markets, what we really focus on is that transition, right? These corporates are really at the early stages. Marcus mentioned about the S-curve. When we think about impact in this case, it's the very early stages. They're really learning about what that means and really sometimes learning that they actually have it in their own business, but were never really proactive in sharing it. So it's engaging with them and getting them to think and even sometimes really educate them in what it is that we're looking for, and then hope that they will be able to give that information back to us. If we don't have it, if that, we have an understanding of the intention of the business, but we cannot measure, then obviously it wouldn't be something that we would be willing to add to the portfolio. So the measurability is important. It needs to be there somehow. And also to be able to measure that transition over a longer period of time, right? Has that been improving, right? Where is the money being spent? Are they putting CapEx into improving sort of that transition going forward? So very important to us.
And William, you're working with not just emerging market, but really globally. So, so how has the measurability, the possibilities to map these sort of impact opportunities worldwide?
Now, well, the measurability of impact, or how you would call it, is always a difficult question. So what we do, because we use the bottom-up approach. We have a story for every investment that we invest in, but at the same time, people want to see that result. And in a world where econometrics has, let's say, a high standing at least, people want to see figures. So we're trying to do as much as possible of this. And we are also working together in groups to enlarge measurability. Now on carbon dioxide, we are getting towards, let's say, a standard that is agreed upon. But I think it's much more difficult on social issues, for instance, and also on healthcare, what Patricia was talking about. But we are developing this further. We work together with other organizations. We look at what is available in databases. We look at what we can find ourselves, what we can develop ourselves, and as such, we have been able to, at least on a relative basis, to let's say give overviews on how our investments do within all of the, let's say, different sustainable development goals. And we report on that to our clients.
All right, I dodged the question. Yeah, no, we are using the SDGs as a framework in our sustainability mapping and work. However, we And then there are, some of them that are perhaps more directly relevant than others. So we find it as a useful tool for framing and understanding a little bit also the larger sustainability challenge. But we don't use it, for mapping and measuring specific investments. We have looked into it, but our conclusion was that it's a very complex and also very time-consuming and associated with a lot of uncertainty to map specific investments or specific companies to specific goals. Or SDG goals or indicators, and we decided that. So we are intellectually not against the exercise, and we're seeing that quite a number of managers are doing it. I think it's a worthwhile exercise, but I also think that it's very time consuming, and also one has to be at least cognizant of the inherent uncertainties, especially when you start thinking about the net impact, because of course you can contribute positively to one goal and then add negatively to another goal. I think we can come up with a lot of examples of that. So what is the net impact? But in practice, we are, because whenever we make an investment, we are thinking through, we don't call it that, but in practice, it's theory of change. How do you think this will change, right? What's going to happen? And then as William was mentioning, in climate, there is CO2. We can measure CO2 intensity. We can also add newer data sets that looks at alignment. So, CO2 intensity is backwards looking. Alignment is more forward-looking, as a governance element to it. We can also look at CapEx, how CapEx flows are changing. Of course, now we're getting into also data issues. How reliable is the data? Can we actually get data? And especially in the world that Patricia has to operate in the emerging world, where data scarcity is an even bigger issue, right? However, I want to make a point. Just because data is poor doesn't mean that we shouldn't do it, right? We have to push companies, and sometimes they're unwilling, sometimes they're unaware. So I think there's both. So we should push companies to disclose more and better data, but we should also think innovatively how we can actually make investments even before we have perfect data sets. Because I'm quite sure whenever we get this data, we're going to complain about some other data that's not available. So I think this is a constant, struggle. But just saying there's not enough data or the data is not good enough doesn't mean that we shouldn't really try to understand how these things work.
And we have a question from an attendee. Diana is asking, what taxonomy reference and measurement frameworks are used, proprietary or SDG based? So not SDG based in your case, but Marcus, you also see quite a lot of different asset managers and how they're evolving in using different frameworks. Yeah. Can you comment on those that have really emerged as being leading there?
Well, let's put it this way. It's a complete mess, because there are so many different. I even think there are 2 or 3 different efforts out there to coordinate and harmonize the different measures. I mean, it's really. However, I'm not necessarily saying that as a criticism. This is a new area. We're all, we're all looking into this, and we haven't done it for so long. So I think it's natural that this is evolving. There are many, many different initiatives, and I think it's very much learning by doing it. And again, we can't sit back and wait. Let's wait till all that is sorted out. No. 5 years down the road or 10 years down the road. Our view is that if you do that, you're going to miss a lot of the also financial upside because you're waiting until the world is perfect. So we are not necessarily telling anyone coming, oh, you're doing it the wrong way. This is the only way that we're going to accept. Of course, it would be easier if if there's evolving an industry standard, this is how we're going to report on the impact. This is how we're going to report. But again, I don't think it's necessarily fair to expect that such a relatively new area, you already have a perfect industry standard.
Yeah, and Diana was stressing that, yes, it's quite urgent given the 7 years to climate tipping point. And William, I saw you like nodding, and you seem to agree with Marcus on this question of being a mess around the measurement taxonomies and frameworks. How do you do it internally?
Well, no, we do. This is something that, of course, we have had a lot of discussion also within our own firm about, and we decided to go for our own, let's say, our own system. We just go from our own philosophy, our own proprietary system, and then, of course, we try to fit in as much as possible also with, let's say, the other ideas that are out there. But like Marcus is saying, I don't think there is a perfect one. I have not the idea that our system is better than anybody else's system. And of course, you have the taxonomy, EU taxonomy, and so forth that you have to prepare for also. So you have to ensure that at least that you have to get to a certain level. But at the same time, there is no, we really think that in the end, also the qualitative part of the story, like what Marcus is also saying, if you don't have the data yet, it doesn't mean that you should not invest in it. If you really believe in it, if you really think this is something that we should do, then you should start investing in it. At the same time, you should also be very wary of starting to get into an activity that in the end proves to be wrong for you. So you have to you have to do your research. It's a matter of doing a proper research before you start doing this.
And that really takes us to the next question in terms of, okay, now we know it's hard to measure, but you still have to do it. You have to push through. You have to do your research. And so how do you avoid sort of conflicts between different goals? Because, you have the environment and then you have society on the other hand. And sometimes it's hard to walk the line in the middle, so if you focus too much on the other, you might hurt the other. So how do you approach that question, William?
Well, it's a difficult one, but we have our minimum standards. So we have set firm-wide, we have set our minimum standards, and we think that every investment has to fulfill the requirements that we set there. Which means, for instance, we don't invest in fossil fuel. So not at all. The banking sector, so the financial sector, we really would like that the investments that we do in the financial sector, that they are getting, let's say, that they are at least looking at, let's say, banking on values. We are, let's say, very much pushing, promoting the Global Alliance for Banking on Values, which is completely different from, let's say, the standard banking. And as a consequence, most of the financial companies that we could invest in, we don't invest in them either. Same goes for, let's say, any involvement in arms. There's absolutely no go. So we are very strict on that. And as such, if a company has a very positive thing, like for instance Tesla, we really like the fact that they are only producing electric cars, but at the same time we have, let's say, large questions on the governance and what is happening in the factories at Tesla. So that for us makes it difficult to invest in this company. So we don't. These are, let's say, you have to be very selective, and I know that makes it more difficult, but that's our real challenge, doing the research, finding the companies that fulfill the requirements and have a good, let's say, financial outlook, and then we invest in it.
Great. And Patricia, then in emerging markets, this must be even more difficult, because often we think about development and economic development in particular as coming together with a certain amount of damage to the environment. How do you manage that sort of conflict?
Yeah. So for us, it's there is the materiality part of it, right? Sort of how material is it? What we're talking about in terms of one sort of washing the other. So if we were to look at some, some sectors, for example, mining sector, right? It's never going to be. I'm never going to be able to justify owning that name in this portfolio, right? It would never happen. Or sort of those businesses, even though, for example, if we use an example, Vale, which is an iron ore company, they have massive programs in terms of the social side. They actually spend massive amounts of money and focusing on small towns around the areas where they have the mining business and so forth. They just came out with a pretty impressive sustainability report, which is very unusual in emerging markets. But that would never fit, because even though they are complying in certain areas, they're being very forthcoming in terms of data and how they're approaching it, but their actual business, right? So then that's where we're talking about the intent. So the intent there, the business that they have, it still doesn't justify, right? Sort of the other side. So I can't think about that. But then there are other businesses, like, for example, the financial side in emerging markets. Yes, banks in general, obviously, are more challenging. However, there are banks that their business and where they're growing, and that's where the materiality comes in as well. They're growing in areas which is really focused on SMEs, very small. They're lending to very small parts of the population, areas that are much more difficult. So that part of the business where it's difficult to have access to banking, period, right? So they're in a way helping people in certain areas. Now, how big is that business for them? It's relevant. So there where the materiality comes in. And also, is that part of their business growing? Is that where they're seeing opportunities? Are they investing in growing certain parts of their business that are actually helping in that transition? So that's how we approach it as well. I agree, it's difficult. It's challenging. Every company, you need to really do a very strong fundamental analysis to understand the businesses that they have, making sure that you are not sort of one washing the other, and also making sure that the areas that are important, where they really have that transition happening, are the ones that are growing, right? That's where you want to be, because they're the very early stages. So in a way, being part of that and investing in those companies, you're also kind of benefiting from that growth and that improvement going forward. That's how we approach and making sure that we are not caught in sort of that difficult challenge of not letting one side sort of wash the other.
Right. It's funny that you mentioned Vale, because it's one of the names that has been really controversial also for the AP funds. I know that some of them have put it on their exclusion list. The Council on Ethics has been thinking about it quite extensely. Marcus, is that something that's important for you in your day-to-day work, the exclusions versus so that help you also take care of some of the trade-offs?
Yeah, so to some extent, yes. So Council of Ethics, it really works on exclusions, as you say. It's also very much conventions, or it may be conventions based. So if there's a convention against something, we the Council of Ethics or we ourselves make a decision. We're not going to have any exposure, and then it could be to a subsector, and that means that we cannot even have 0.0001% exposure, right? Then it's off, and no questions asked, right? Then it's out. So that's one end. And that's pretty clear. I'm normally not involved because it's not a financial or economic consideration. It's an ethical or conventions. So that's clear cut. But then, of course, and I actually want to pick up what someone, Patricia, mentioned about materiality. I actually wrote down materiality huge on my notes as she said it. This is key, right? Because in a lot of these, except for when we get an exclusion decision from the council, we really have to understand what is this, what's driving what, and in some thematic there are pure plays. We can just put a lot of money into a wind producer or a solar producer, fine. That's pretty straightforward. In many other areas, there may not be pure plays. And we have to think, to give you an example, there is one of the largest renewable energy producers in the world also have coal assets. Yeah. Not much, and it's falling, but so how should we treat that? Do we think that they're actually going to phase it out and then increase even more? That's a business decision. I think is a good example. Another, Patricia mentioned mining. Today, I don't know if you saw it on the front page of the Financial Times is the announcement by one of the Swedish iron ore producers, KAB. They're going to invest $47 billion over the next 20 years to become carbon-free, to be able to produce carbon-free iron ore. Again, I'm not saying we will or we will not, but that's certainly not a pure play right now. If the world can produce carbon-free iron ore, that's a huge win for the environment. And I think different asset owners, different asset will make a different call on that, which I think is fine. There's not necessarily one size fits all, but within your organization, you have to be clear. This is the theory, this is what we believe in, this is the CapEx flows that we believe in, this is the alignment that we believe in. I'll give one last example. One theme that everyone around the table was really excited about was alternative proteins or plant-based food, right? Everyone, in Sweden, you go to your local grocery store, you see that part of the selection is increasing every week, right? It's just getting larger and larger and larger. It's really, really hard as a mid-sized asset owner to get meaningful exposure to alternative proteins, right? And it may be at the end of the day, it may grow, but it may also be that it's the large food producers that are going to buy the niche players, and then they're the ones that are really going to drive change, because then they're going to tell your local grocery store, well, now it's not only that little lot, now it's a big one, right? So and again, different managers, owners will make a different decision, but you have to think through what is the materiality, what matters most to you, can we take the risk that's remaining because we think the upside was going to be big.
Right, and for asset owners like yourselves, engagement is a quite important tool in order to drive this kind of changes. Can you tell me, I know that it's a topic for a whole other webinar probably, but just give us a quick summary of how you look at these engagement themes and how much difference you think you can drive.
Yeah, no, we think it's absolutely crucial. We do divest from certain things, apart from the Council of Ethics, but we can also be from subsectors that we don't think have a future. I think I can give one example, tar sands. We don't think that has a future, so we have divested from companies with exposure to tar sands. But then there are others, a lot in between there. Do we think they can do things better, more sustainably? Yes, and then we engage. But then the engagement differs a little bit depending in what portfolio. If it's an actively managed portfolio that's more concentrated, we can be very active. We can sit on the nomination committee. We can write letters. We meet with the management, often and repeatedly. We can talk to them. If it's in a more passive or larger portfolio, well, we may not be able to see them as often, but we can certainly work with other investors, a lot of consortia, Climate 100 Plus, TPI, and so on, that we can push them together, and we can vote in annual meetings and so on. So there are a lot of things you can do, but also you do it slightly differently depending, what your stake is.
Right. I think we could actually take a couple of questions that we have from the audience. Davide is asking a question for William. What would you tell your investors who argue that it's not possible to exclude large subsets of companies based on ESG considerations because it would increase the risk of one's portfolio, the risk to diverge from the index mainly?
I can be very short on that one because we diverge a lot from the index. In fact, to be honest, I don't care about the index. So we look at it, of course. Our clients want us to compare us with the index because they want to know where the differences are. At the same time, I think that's not the real risk. The real risk is your return, your absolute return, and your volatility of that return. And the relative risk is interesting. It's good to know, but we have a large divergence from that. So the active share, as people call it, is close to 100. So I would, if you really have worries about, let's say, the relative risk towards an index, I would just urge you not to invest in our funds. Yeah, I'm sorry for that.
All right, but yeah, and it's like to follow up. Diana has a question about the value chain, which is like right into our next theme. How do you look at the whole value chain as opposed to a whole company? So, for example, in the example of Vale or other mining companies, the products that the raw materials that come out of that value chain will end up in some consumer products, or for example here she says laptops use cobalt from mines in Congo, for example. How do you look at that? Perhaps Patricia first, given that you're closer to the emerging markets, and then William, you can add to that.
Yeah, sure. So for us, we look at the company, specific company at the time, right? So, and then maybe I'll give an example just to illustrate that. So we have in our portfolio this name, it's called Tenda. It's actually a real estate company in Brazil, very focused on popular housing. So the way that most of the funding happened there is with help from the government. The government is very proactive in helping the very lower part of the population have access to housing. There is a huge deficit in the country, okay? So very much needed. So it's the very popular housing that they produce. So they fit in our portfolio. The reason why, obviously, even though it's with sort of some help from the government in order to be able to achieve that, the market that they are focusing on is a part of the population in Brazil where they would not be able to just go to a bank and get financing. So the financing is coming from the government. They work close with the government to actually produce those homes, okay? So that's why they're there. Now, if you look at the raw materials for them, obviously cement, for example, is big, right? They need the cement. Cement is never going to be part of this portfolio for the obvious reasons, right? Sort of incredibly very pollutant, and it doesn't belong there in this portfolio. So there's serious environmental issues there. So we look at each one of them individually. So Tenda is actually serving a part of the population that don't have access to financing, don't have access to housing otherwise. So positive in that respect. Remember, it's all about the intentionality there, right? That's the intention there. But the value chain, so the suppliers, the steel producers there, the cement producers, are not going to be in this portfolio for the obvious reason, because they themselves, right, are in completely different sort of businesses, different challenges there from an ESG point of view, and certainly an impact as well. So we look at each one of them individually for us. And if they belong, it's great. If you can fit the process and also be able to see sort of the goal that they're achieving, perfect. If not, then it's a completely different thing. So it's very separate for us.
Great. And William, do you have a similar approach, or do you have other demands?
Well, no, for us, we really look not only at the company, but also on what its position is and the value chain behind it. So, for instance, you mentioned cobalt. We really look into this, and we also participate on all the initiatives that are there. We actively participated on the UN initiative on this in Geneva some years ago. And we really look also, and we ask companies also in the meetings with companies, we really ask them how they, let's say, make sure that they are not involved in this kind of, let's say, let's say, despicable activities. Let's be honest about this. And if they are not able to do that, you know, we are very willing to listen to them. We are even willing to help them finding solutions for it. But if they are not able to prove that they are really doing their utmost best to avoid these kind of things, well, I'm sorry. We discuss this with a lot of people, and sometimes people ask us why we invest in a certain company. So why do we invest in Danone? And we know that there are some problems, and we discuss this with the company again and again. That's the engagement that we do. And if we are not longer convinced, we will divest. But if it's not like a matter of somebody comes along and says, well, this is happening there and you should divest immediately. Well, that's not how our process works. We first start to look into the problem, discuss it with the companies, see what they are doing. And if we really are finding a problem there, then we divest of it. But there is a period that we have to look into this first. And we always rely on our own research for this. So that's our approach in general.
And Marcus, you wanted to add something there?
Yeah, but actually to the previous question, but something very practical. It was about the index and so on. I think there's not a solution, one overall solution, but there are many different solutions, right? One solution, a PM, a portfolio manager, often gets his or her index. This is what you're benchmarked against, right? So if that is set, then you can work with you can work with, reallocation within that, right? Maybe you have a tracking error mandate. But then you can optimize within that, right? So you can do a lot within a set benchmark or index, but you can also change, right? That may not be up to the particular PM or even the team. Maybe that's a management question or a board level question. But, again, you come down to your analysis. Do we think, the risk is so big in these subsectors that, that we need to exclude it? And who bears that risk? This sounds like trivial questions, but it very much also depends who's gonna, make that call and who's gonna bear that deviation from whatever you're benchmarked against, right? There's no lack of indices here, right? I don't know how many hundreds or thousands there are. You can, have an index for whatever you want. Or you can ask, any index provider to create a new one for you. So I don't think we should get hung up on the technicalities. We should understand, what is it we want to change and what can we change within the existing structure, and if anything, what needs to be elevated and then discuss there. Either, that entity takes the risk to deviate or change the benchmark and the index. I think all these things are doable, but sometimes we sit with our own mandate and we think what can we do, but sometimes you need to elevate or think how can we actually work within the existing structure.
Yeah, talking about elevating the level of challenge, we have a question here from Christian, who's asking about net zero and that kind of commitment. He reminds us that the WMO report yesterday pointed that record CO2 emissions were still going on despite the COVID lockdown. And so he's asking if AP4 has a plan of making this kind of commitments.
I don't know, because it's not my call. I think I will be involved in the discussions and whatever but I think regardless if we say a specific year or not, I think the fact that we're very clear in all our communication, in our climate scenario, in our that we work towards Paris. But even more so, we work towards 2 or 1.5 degrees. That's what we're measuring against, but that's a very long time scale, right? But we also try to break this down. What is the next 10 years? And there we focus more on things that we talked about today, the climate transition. But then we also have we were talking very much about a feedback loop between also physical risks and transition risks. And I think that was also very nicely articulated by the FSB coming up with a new report yesterday or the day before yesterday, where you're saying, understanding also at what time frames does different factors play out, and also, in the very short term, how do things play out? So, I'm not trying to dodge the question. Is that to be frank, I don't know, but I think also at the end of the day, regardless if whatever date we say, our work is still pretty clear what we're working towards.
Right. And we have also a question of detail here. I don't know if we have time to answer this, but maybe quickly about scope 3 emissions. If that's something that, if that was something that you had to disclose, would that change your portfolio? So perhaps a quick round around the table here. Yes, no.
No, it would not change.
And William?
No.
No.
No. No.
Any idea, Marcus?
Well, I can't say because we don't have scope 3, but we've looked at scope 2.5. We've won half, basically half the first level of indirect, and no, I wouldn't say it doesn't change materially. No.
Excellent. Well, we have a couple of minutes left just to wrap up. We've talked about quite a few themes. We've insisted on the materiality, the importance of that, the measurements, which is still a mess, but it's not an excuse for not doing your analysis properly. We've talked in general about the transitions and looking at whether you can have you can bet on the right actors, whether they are pure plays, first movers, or if they're losers becoming winners. Perhaps a quick round the table to conclude. If you had one particular advice to people, focus on a transition theme, where would you start? What is the most important thing beyond the considerations we've talked about today? Marcus, do you want to start?
Yeah, no, I think one thing that a guiding principle, which is used to keep, there are a lot of things we don't know here, but we think, well, we're convinced the direction is clear, right? We're moving towards a stronger, from a weak towards a stronger transition. We don't know exactly how strong it's going to be, but it's accelerating, right? And then you can play in China's 2060 net carbon, Biden victory, CO2. I mean, all of so we think we know the direction, and we think it knows it's accelerating rather than decelerating, right? And that gives you it's on risk reward. It's probably better to be proactive rather than reactive, right? We may still be too early, or we may miss things, but that gives you also an understanding on where the risk reward lies. And I think that's quite helpful when thinking about this and all the uncertainties.
Excellent. William?
Yeah, I think I agree with that. We are moving in the right direction, and maybe it's our task to be, let's say, a bit upfront of the music, but we are positive on this. On the same time, we also, despite COVID, because COVID is a setback. It's not promoting change. It's actually a setback of change. But I think this really creates an opportunity for us to start really looking at in another way at things, and the way we value things, the way we look at kind of measures and how we should promote certain things. I think that is something that we should take as an opportunity. So that's where we are looking on, and try to find that. Yeah, and at the same time, let's be honest, 10 years from ago, we weren't even thinking about these kind of things. So there is real progress somewhere.
Great.
And I leave it to Patricia for the emerging markets.
Patricia.
Yes. So I agree with Marcus and Williams. The trend is very positive here. I think we all see that. I think specifically in emerging markets, we're at the very early stages of that sort of trend and improvement, right? Companies are really learning and figuring out what they need to do, what it is that asset owners, investors are looking for. But I think that creates a tremendous opportunity there. I think asset owners have really the opportunity to influence emerging markets significantly. And that's obviously by being very proactive in how they invest, in being very selective and what they're looking for, what it is that they, regardless of how they internally, right, think about investing in that transition. But because it's at the very early stages, so the asset owners can actually influence corporates to really expedite sort of that transition and make it happen a lot faster and catch up with the rest of the world much sooner if they actually are proactive in selecting the right names, because the ones that are falling behind will pretty soon realize that the premium in the ones that are actually doing well and doing better and being obviously focusing on that the impact space is actually benefiting. So they will obviously, so you move the whole market, the whole emerging markets along with it. So I'm very positive. I think we collectively have an opportunity to be really big influence in that space.
Great note of optimism to finish this call. Excellent. Thank you so much to Marcus, William, and you, Patricia. I hope that we've been able to inspire the attendees to make better investment decisions in terms of sustainable transitions. And you'll find the recording of this virtual roundtable on nordsip.com within the next week. And on this note, I would wish you all a very good afternoon, and Patricia, a very good day. And I hope to see you again soon.